I'm just gonna sorry.
No, you literally just
No, but the screenshot also makes if I don't it's not gonna fit into this. It's not gonna
Last spot ever. Oh, dude. That was me when I tried talking to him. Oh, yeah. I like I think I got what class is that? I got this Porciano's. Let me show you. No, I got the green. I got that too. Are you the captain though? Oh, yeah. Best team member.
She was just saying. No, she,
My favorite. That's the same. That's the same. I got that. I got all three of the same. I mean, I might think that you and I are not exactly the same. Yeah. I can put you on. Rather be charged by a there's definitely like
Wow.
Wow.
Hey folks, welcome back for the last time. You do have your exam still in front of you. I just picked up a mocha from the thing, and they forgot to put the chocolate in there, so it's mocha without a chocolate. What is it? Basically a latte, I guess. But that's between me and the coffee shop. But your final exam, in case you're still keeping track, is next Monday, 2 to 3:50 p.m. Why do you act like you've never heard this before? You've known this forever, okay? And if you're taking the early version, it will be Wednesday from 1:30 to 3:30. I know it's off by 10 minutes, but I'm syncing you with the MBA class. It's also taking at that same time. It will not be the same exam. So if you're thinking about passing the exam or selling it after you take the early exam, I wouldn't even bother. It's not going to be the same exam. Okay? So today I'm going to use the numbers you sent back to me as the basis for reviewing the entire class. And I want to emphasize the word that you sent back to me. You know how when you get an investment email from an investment banker, it'll be a 3-line email, and then there'll be this long, text at the bottom, basically saying, don't hold me responsible. So essentially, whatever you see in the numbers, these are your numbers. If you think the numbers look strange, not my fault, right? I'm just reflecting them. So let's get the process rolling. At the start of this class, I said there were 3 ways you could put a number on an asset. One is to do intrinsic valuation, and I'm going to use a less purist way of describing what you do, where you basically sometimes desperately try to find a story and numbers and convert it into an intrinsic value. The second is you can do a pricing, where you can pull up a group of companies that you claim are just like your company. You know you're lying, I know you're lying, but we kind of let it go through. And then you control for differences. The third is you argue that equity in a company, you can rip off the lenders, which is what the option pricing model is, and do a liquidation option. Okay? But let's do a very quick review of what intrinsic valuation is all about. By now, you've immersed enough that I can give you the review. When you see a discounted cash flow model, that equation, you're basically answering 4 questions in that equation. The first question is, what are the base earnings and cash flows you make on your existing assets, right? That's what gets you started. So when you look at the existing financial statements, that is what you're getting the answer to. The second stop asks you, what is the value in your company of future growth? That value can be positive, it can be zero, it can be negative. And where does it show up in your valuation? It shows up through the growth rate you use and through the reinvestment. Or put in terms of the FCFF simple Ginzu input, the good side is the revenue growth, the bad side is the sales to capital. The net effect is what's going to determine whether growth is good, bad, or ugly. The third is how risky is your company? We can dance around this, but that cost of capital that you give me is a measure of the operating risk in your companies. The operating risk is high, the cost of capital will be high, and the operating risk decreases, the cost of capital will decrease. But there's another element of risk, which is your company might not make it. So you bring that in to the risk somewhere in there. And then I ask you, when will you be a mature company? Daisy, why do I need the answer to that question? But why do I need to know when you become a mature company? What does that allow me to do in a discounted cash flow valuation? Because that's the only time I can put closure, assume your cash flows will grow at a constant rate forever. It allows me to get a terminal value. Next time you see a DCF, I want you to take the DCF apart and think about what is the answer to each of those 4 questions, because it's embedded in there. And of course, in my parsimonious model, it shows up as revenue growth, which captures the growth part of your business model, operating margins that reflect where your unit economics, economies of scale, all the neat stuff you want to tell about your profitability in your business model, and your reinvestment. That tells me how efficiently you deliver growth. Those 3 inputs give me my free cash flow to the firm. There are 2 numbers I use for risk. One is a cost of capital coming from your cost of equity and debt that captures the operating risk. But I also bring in failure risk as a separate input because it can affect the value of your company. So that's a lead in. And each of you had to do an intrinsic valuation of your company. Now, if you remember midway through the semester, I offered you that one-time deal. And you sent in me Excel spreadsheets expecting me to do magical things. Like your growth rate is 18%, but this company's growth rate is actually 20. I don't know what you think I know. I don't know the growth for every company in the face of the earth. In fact, some of your companies I'd never heard of. But here's all I did, and I'll give away the secret. I was checking whether your story was at war with itself. Let me explain. You came up with the growth part of your story. And I'm going to say, okay, it's your story. There's one person who did put in 125% growth rate for NVIDIA for the next 5 years and ended up with a $26 trillion revenue in year 10. And I think that growth story I cannot live with, because that would make you 5 times larger than the Chinese economy over time. So clearly that won't fly. But most of your growth rates, I step back and said, it's your company. You want to tell a high growth, an average growth, a low growth, or a negative growth story. I'm okay with it. Then you told me a risk part of your story through your cost of capital. You might not have told a story, but you gave me a cost of capital, higher, lower, or pretty close to average. And then in your same valuation, you gave me a reinvestment number. It's actually the number that separates my after-tax operating income from my free cash flow to the firm. That difference is reinvestment. I consolidate into one item, but you can have 4, 5, 6 line items. When I see high growth in your revenues, and I look at your reinvestment, I expect to see high reinvestment. And look at your cost of capital, I expect to see a higher than average cost of capital. Not always, but that's the usual pattern. When I see low growth, I expect to see low reinvestment and low risk. That valuation triangle, and we talked about this earlier in the context of storytelling, is a great way to run this yourself. You don't need me to give feedback. In fact, please don't be sending me your DCFs every 3 months for the rest of your lifetime. Say, can you give me feedback on this? Because my bandwidth is only so much. You can do it yourself, because that's all I did. I checked your growth, your reinvestment, and your risk to see if they're internally. And if they were not, I was looking for a story to explain why in this company you can grow without reinvesting very much for the next few years. So now let's turn to your company. So you had to pick a company, right? And I said you could pick any company. I was happy to see there were 6 of you who chose to value private companies, usually a family business. So they're the one thing you will not have is the market price. And that is a disadvantage, because there's nothing you compare your value to. You have no sense of whether you're off the planet or on the planet, because there's nothing to keep you. But I'll let you pick any company you wanted. And I remember early in the process, somebody coming to me and say, I'm picking a company, but there's somebody else in the group who's already picked the company. Am I allowed to pick it? And I said, sure. and many of you picked the same company. NVIDIA was the most chosen company. 6 of you valued NVIDIA. 5 of you valued Celsius. I'll be quite honest. Celsius was not even on my radar. And after you guys started picking Celsius, I went to the grocery store, actually picked up a couple of cans. I don't like it, but somebody must. The guarana or whatever they add, it supposedly will make you younger, brighter, richer as you drink it. I don't buy into it, but it's clearly the beverage company of the moment, and it's caught on. And Walmart, the exact opposite of Celsius, is a boring discount retailer. BYD, there were 4 of you: Costco, DraftKings, Lululemon. I don't know what it is about Lululemon. It's just, it shows all 3 of my classes. It's up there in the top. No, I don't know whether you wear Lululemon in secret and you don't want to reveal it. You're valuing the company, but whatever it is, it keeps popping up towards the top. It's, to me, it's a boring Canadian apparel company, but something must make it exciting. Spotify, Novo Nordisk, partly because it's in the news, and Lyft, and Boeing, Airbnb, Beyond Meat, Coinbase, and On. On is another company I hadn't even thought about much. On is this footwear company, a Swiss footwear company that's kind of taken off, in the last couple of years. So sometimes I'll see in my valuations companies pop up because they've caught the popular, whatever the zeitgeist is of the moment. Now, here's the reason I'm okay with you valuing the same company. There are 4 of you valued Netflix and 6 of you valued NVIDIA. At least you got the countries are the same. The one said USA and the other said United States. I think it's the same country, so that's okay. Okay, the dates are obviously different. Some of you were a little ahead of the game, some are within the same week. And the price differences reflect when you did it. But take a look at the DCF values and the pricing. No 2 numbers are exactly the same, right? Why? Because, and you can see why. When you do an intrinsic valuation, you get to choose. You make choices in your story. You make choices about your growth rate. So I've had people value the same company, 14 people in the same class value the same company. And not one of them will get the same number as somebody else. Does that make one right and the other wrong? In hindsight, some of you are going to be righter than others, but only in hindsight. So you can have the same company, very different numbers. And, when you get big differences, clearly you make. In fact, with Netflix, there was 1 buy and 3 sells. Thanks. And you can see that, it clearly can't be based on the pricing. It's got to be based on the DCF value being much higher, but you can see that there are wide divergences within Netflix. And I think they're all plausible. Remember the words we use? They're all plausible. The question as an investor is, which is the most probable? Okay. So here's what you found in your DCF valuations. Let's focus on the median. Your median company was overvalued by about 14.2%. So collectively as a group, you found more overvalued stocks and undervalued stocks, 150 to 86 in median company. This is a number that varies across time. Right now, this class and the MBA valuation class, they were more overvalued than undervalued. We'll come back and talk about what that might tell us about the market, but far more overvalued stocks and undervalued stocks. The typical stock was overvalued. Saying, why is the average so much higher? Because you have more outliers on the upside than the downside. I've also listed the first and the third quartile. There are enough companies at the first quartile, you are getting undervalued stocks. So negative basically means you're undervalued. So now I'm going to show you your list. And I want to emphasize the word your list. So if you do something and buy this, don't blame me, right? So these are the most undervalued stocks according to you. Notice how I'm passing the responsibility back to you. Okay. So basically, I took your DCF value, I took your price, and I looked at the price as a percent of DCF value. Lee, who did Lee Auto? Don't worry, I'm not going to pick on you. Is that a Chinese electric car company or what is it? Is it a Chinese electric car company? So it's a smaller version of BYD, is that what it is? Or is, no? No, so you did BYD. So tell me what makes Lee different from BYD.
Focusing on plug-in hybrid, not like.
Oh, they're not the car company. So they're just plug-in hybrids like a Toyota Prius. Okay, so they're high end. So I've never heard of it. So I'm planning to look at it. And so Lee was, then as you go down, there is on, which is one of the undervalued. So as you go down the list, you can see there's a wide variety. In fact, hims and hers has been in a little bit of a social media blowback in the last few days, if you've been reading the news, but you see a wide mix. Now I'll make a deal with you. Every year that I've taught this class, I pick one company from this undervalued list and I buy it. But here's my condition. Here's my condition. I will buy it if you buy it. So don't tell me buy. I don't have any money now. I might have money in the future. You put your money behind it. I'll put your money. So if you're on this list and you're buying the stock, are you buying BYD? Okay. That's one of the conditions. If three of you, then I have to flip a coin and say, I have a bit three-headed coin, but I'll eliminate one at a time. But I will buy one. I'm not going to buy three. I can't load up on three of your stocks in the same semester. God only knows where that will take me. Okay? But I have to do it. If I didn't do it, then I'm basically saying I don't believe this class is actually stuck. So that's my way of saying, okay, I'll show you in a moment what these stocks have done over time, because after 40 years, this portion of my portfolio, I have some history I can point to. But those are your undervalued stocks. Here are the most overvalued stocks. At the top of the list is AMC. Who's doing AMC? Okay. First, when you get a negative equity value, why does that happen? Because the value, in fact, AMC, the value of the business is less than the value of the debt. You're going to get negative equity value. In fact, in my MBA class, guess what the most overvalued stock was? AMC. AMC owes $9.4 billion in debt. What business is it in? When was the last time any of you went to the movie theater? Few of you did, right? But if I'd asked this 5 years ago, you'd have far more hands go up. Why have we stopped going to the movies? And don't tell me COVID. I'm sick and tired of blaming everything on the pandemic. This predates the pandemic. Why have we stopped? Yeah.
Like the streaming is like kind of
Streaming and 70-inch TVs in your living room, right? I mean, if you go to Best Buy, you can buy a 70-inch TV for what, $650. You go to an AMC theater, especially one of those small theaters, you have a 70-inch screen and you're with 45 other people you don't like. And you can't do things like sit around in your underwear and eat ice cream while you watch the movie, which you can do at home. So one of the problems that the movie theater business is facing is streaming plus technology has made the movie business. And it's, as I said, it predates COVID. COVID obviously was a tipping point. And you know why it was a tipping point, right? Because during COVID, movies were released directly to streaming. If you remember, it went directly to HBO. Once that door was opened, it no longer became, you always go to the movie theater first. So the theater business is broken. AMC is in the broken business. And no matter how much you try, there's one person in the MBA class who came to me every week for the last 15 weeks trying to get the equity value positive. Said, can I try this? He tried everything and finally said, I can't get blood out of a stone. AMC is overvalued. So when you see that negative, it effectively reflects that. In fact, WeWork was the other one. Where's the WeWork person? And I tried so hard to talk him out of doing WeWork. He came in and said, do you really want to do WeWork? And he said, I do. And unfortunately, WeWork has a different kind. When you have broken business models and you're trying to do an intrinsic valuation and you have debt, you're going to have a really tough time getting that equity value above zero. So these are the most overvalued. If you own these stocks, you'd be selling them. But my guess is none of you. Are any of you planning to sell short anybody on this list? You are? I'm not selling short. I'll watch you on social media to see how well you're doing or how badly you're doing. Because the problem with selling short is, if you find NVIDIA to be overvalued and you sell it short, you might eventually be right, but you're probably going to be bankrupt before you get right because the world can move in the opposite direction. Right? So those are the most overvalued. I pulled these off at about 10 o'clock or 9:30 this morning. So if you Still haven't got your numbers in. I think there were a couple of companies where I didn't see the numbers, but almost all of you had turned in the numbers, so it's a pretty complete list. So now let me give you a sense of what these stocks have done. This is almost my 38th year teaching this class, and at least for the last 35, I've had these buys and sells. So I've look at least, and I have to give them enough time. I can't do it the next 3 months or 6 months because you're doing intrinsic value. You're saying I need time. So about 5 years in, and I should update this because I have the September 2014 and the 2019 numbers now. I track to see what the buys, the sells, and the holds have done historically. I'll start with the good news. If you look at the buy, so the buys are the blue and the sells are the green and the S&P 500, there is, I mean, if your buys and sells were complete noise, what should you expect to see on this graph? The buys and the sells should have roughly the same return. So there, it's not, so that's the good news. It's very low. It's a very low bar to clear, but your buys on average do much better than your sells. Okay. So at least the first bear. And then I looked at whether you'd actually make money buying the buys and the sells, and you do, but then it's a noisy signal. Let me explain what I mean by a noisy signal. About 60% of your buys go up, but not 100%. But about 45% of your sells also beat the market. So it is noisy, which effectively means if I were to take all my money, I would not buy your cheapest stock, Lee Auto, and say, please God, let this work out, because that would be asking for trouble. Second, it turns out that the buy recommendations on small and emerging market companies historically have done better than the buy recommendations, the NVIDIAs, the Apples, the Metas. Do you see why? Why might that happen? It's to make money in investing, you got to bring something to the table. Let's face it, when you value NVIDIA, Meta, millions of people are trying to do it. It's very difficult to find that edge. I'd never heard of Li Auto, right? I'm fascinated by the fact it looks undervalued. It's entirely possible it's under the radar because when you talk about Chinese electric car companies, BYD sucks up all the oxygen in the room, right? It's a company that, maybe it's an under-discovered stock. So there is a reason to believe that when you do that extra work on less followed stocks, there's a greater chance of making money. Third, every year that I've tracked these portfolios, I'd love to tell you that all the buys have made money and all the sells have lost money, but that's not the case. In fact, collectively, 90% of your portfolio underperforms, even on the buy, underperforms the market. You see, where's the extra money coming from? 1 or 2 winners in every year are the reason you're delivering more than the S&P 500. I'll give you an example. In the 1999 group, one of the stocks that somebody picked was Apple. Apple in 1999 was close to bankrupt. So in hindsight, you think that's amazing, but 1999 was a terrifying company to buy. Then you go forward to 2004, and each time you look at these stocks, it's usually, and there's a lesson there for investing, and this has been true for equities through history. Do you know that if you take the top 50 stocks out of the market, in the US market over the last century, you'd have earned less than the T-bond rate on the rest of the stocks? In other words, if you miss the big winners in the market, it's almost impossible. Forget about beating the market. You can't beat investing in T-bonds. And one of the problems with people trying to replicate, how can I make money, is you buy the portfolio of 50 stocks, and then you get impatient. You start to sell off a few. And if you're unlucky, you sell off the Apple in 2001 because it hasn't come back yet. So as you look at these results, you're saying, okay, let's make money. Think it does come with a qualifier. This assumes that you buy all the stocks, you hold them for 5 years, and over the 5 years, you make money. It's coming from those skewed payoffs. And those stocks that were both undervalued and underpriced did much better than stocks that met only one criteria. If I go around this room, some of you found stocks that were undervalued and underpriced, about 20% of you. About 35% of you found stocks that were both overvalued and overpriced. And your project write-up was so easy to do, right? Because you got to that last paragraph and you said, my stock is both undervalued and underpriced, and I will buy the stock, especially because you're actually not buying the stock. You can at least write, I'm buying the stock. It was overvalued and overpriced. Stock is overvalued, I'm not touching the stock. But for the remaining 40% of you, you're faced with this quandary where it was undervalued and overpriced or overvalued and underpriced. Okay. And historically, when you get both signaling in the same direction, it's been a stronger signal when the two diverge. Which is the reason when people say, do you know what to value a company or price a company? Your answer should be, why do I have to choose? Why can't you both value a company and price the company? Because if you get an undervalued, underpriced company, you have two things working in your favor. I mean, do you care that you make a 30% return because an underpricing got corrected or either way you make money, right? So to you, it makes no difference. So remember that, you don't have to pick, you can do both. And even though you might have a preferred approach, go with, check the other one. So I want to do a little tangent and talk about something I didn't get to in my last class. Remember I talked about the ways you could change the value of a company? You can increase your cash flows from existing assets. You can try to get more value from growth by either growing more if you're in a good business or growing less if you're in a bad business. You can try to reduce your cost of capital, or you can try to build up your competitive advantages, your barriers to entry. So when you think about any company, you can think about valuing it twice. Almost all of you have valued it once already. So when you valued a company, you looked at the company from the outside in, right? So if you value BYD, in a sense, it's not your company. You tried to figure out what BYD will do given who's running the company. You build it into your valuation. But as you value a company, sometimes you pause and say, if I ran the company, I would do things differently, right? And when you do a valuation, the initial one, you don't want to bring that in. It's not your company. You don't want to replace the actual debt ratio with a target debt ratio because it's not yours to make. Let's say I let you value a company a second time with you in charge. And assume that you can do things differently and better than the existing management. You're going to get a value for your firm. And I'm going to give you I'm going to act like you've done it optimally. You know exactly what you're doing. That value of the firm that you get optimally and the value that you get with the existing management can be different. So let me start with my first proposition. If you have a company that's already perfectly managed and perfectly run, that difference of you running the company is going to do nothing other than perhaps lower value. But if you have a badly managed, badly run company, or even a well-managed company with some weaklings of things you might do differently, the value that you can get from running the firm differently can be higher than the status quo value. That's the first half of the value of control. But to do this, you got to change the management. So the second element that comes in is what is the likelihood that I can change the way this company is run? Let's think of some of the things that you're going to look at. You're probably going to look at, are there restrictions on takeovers, either at the country level or the company level? US companies can put in takeover restrictions into their corporate charters. All they have to do is get an annual meeting. They can raise the percentage of shares somebody has to buy to take over the company. Or they can put in other restrictions. You're going to check for that. Second, if your company is like Facebook, you already know you're screwed. You can't change the management of the company because Mark Zuckerberg controls 57% of the voting rights, and there's not much you can do. You're going to look at access to capital because to change the company, you often need access. If you're in a market where it's difficult to raise capital, it's much more difficult to change management. And finally, you're probably going to look at the size of the company. If you think Microsoft is being run badly, it's going to be much more difficult for you to do much about it because where the heck are you going to raise $3 trillion? Maybe you have a place you have, but if you do have it, let me know where it is. No? Larger companies, you're kind of stuck with it. So you see the two elements come into play. The likelihood of change times how much value can change. That's the expected value of control. I'm going to use that to talk about a variety of things you run into in markets, but this is just a summary of all of the different places you can go. It's actually a summary of what we did last class. So if I come to you with a company, where you're going to go to find additional value is going to be different for different companies. Let me try a few on you. Let's assume that I'm in a mature company, a manufacturing company. I have a long history, but I've fallen into bad habits. I think I have a lot of fat and flab and high costs. When you come into the company, where's your biggest source for value enhancement? Sorry? Or existing cash flows. You're going to try to run the business more efficiently. You're going to cut costs more efficiently, not from growth or lowering the cost of capital or adding to barriers of entry. So your focus is on cost cutting. If in contrast, I come to you with a semiconductor company that, let's say Intel, which has fallen on bad times and it's kind of viewed And I say, what would you different the company? Well, you're going to focus not on cutting costs because that's not where the value comes from, but perhaps reorienting strategy so that you can deliver more value for growth. Do you see where I'm going, right? The fix for a bad company is going to be different for different companies. And herein lies a problem. CEOs acquire reputations because they come into a bad company and they fix it. They get a reputation as a turnaround CEO. So the next time another company gets into trouble, guess what they do? They hire the turnaround CEO. You got to be very careful who you've hired. I'll tell you a story of a guy called Al Dunlap. Have you heard of this guy? His nickname was Chainsaw Dunlap. And he acquired it because he came to a company called Scott Paper, obviously a paper company that had huge inefficiencies in operations. And guess what he did? He cut costs. And he did really well. He turned Scott Paper around. He got a reputation as a turnaround CEO. And he retired from his job as CEO, relatively young. A few years later, another company called Sunbeam gets into trouble. And Sunbeam's problems are not like Scott Paper, wasn't inefficiencies. They'd lost their way on growth. So they hire Al Dunlap because he's got this reputation. He comes into Sunbeam and guess what he does? He cuts costs. He's like a one-trick pony. You hire him for CEO of NVIDIA, he'll cut costs. It's a one-line strategy. He's reading from a cookbook and he's stuck on the same page. And unfortunately, that's a problem with people who have turnaround reputations is they think because it worked at one company, they can repeat in other companies. Already you can see the first step in fixing a company is diagnosing where the problem is coming from so you can direct your attention there. So as you look at the value of control, you're going to look at all of those things we talked about, takeover restrictions, voting rules, access to funds, size of the company, and you're going to look at how much you can change the value of the company because that's what's going to drive the expected value of control. Now, one of the trickier things is how do I attach a probability that my company will change value? I would love to tell you the answer is easy, but I can tell you what to look for. One is you're going to look at the corporate governance rules that govern the company. Now, one of the ways to think about corporate governance is when corporate governance is really bad, you cannot change the management of a company. I remember a few years ago, I got a call from a regulator in an emerging market where corporate governance had been dead. And he said, we're trying to get these new corporate governance rules. How do we market it that it's a good idea? He said, how will it show up in markets? You know, any ideas? When your corporate governance is dead, what will happen to every stock? It's going to trade at roughly status quo value, right? There's no chance you can ever change it. I said, if you can even open the door to the possibility of change, you're going to see stock prices rise, not because companies have been fixed, but now you've increased the chance that companies can be fixed. So first is corporate governance rules. Second, and I mentioned this about activist investors shake the boat. They kind of shake up things. And if nothing else, they change the likelihood of change, not just in the companies they're targeting, but in the other companies. I mean, Nelson Peltz and Disney, if you look at the story said Nelson Peltz lost, Disney won. But technically, that's not true, right? In the few months he was involved, he kind of changed the way Disney actually would never have taken ESPN and created that partnership with the other because that came because they felt pressure from below. So activist investors make a difference. And finally, when you see a hostile acquisition in one company in a sector, it's amazing how the fear factor rises in other companies. They said, there but for the grace of God go I, maybe I need to look at how I run the company. So it's subtle, but it's, that's what drives the problem. So you're saying, how do I come up with a number? I'll give you a way of doing it, but it will require some going back and looking at your statistics. You know how we run regressions, right? By now you have a dependent variable and independent variables. There's a variant in regressions called probits. I'll explain what a probit is. Let's suppose you want to find out what the likelihood of management change at a company is. So you go back over the last 20 years, you look at the companies where management has been changed and companies where it hasn't. Let's say management has been changed in 250 companies, it hasn't in 1,000 companies. So that's over the last 20 years. Then you start coming up with hypotheses as to what causes change. You say companies whose stock prices have done worse are more likely to see change than companies whose stock prices have done better. companies where there are no voting anti-takeover, components in the company. So in a sense, you list those out, and then you take the companies you got the data for, the 250 companies where there was change and the 1,000 companies without, and then you collect the variables. We talked about dummy variables, but usually in the example that we did it as an independent variable. Here you make your dependent variable into something that looks like a dummy variable. The companies that change get a 1. The companies that don't get a 0. You throw the variables and you run something that looks exactly like a regression. But now if you plug the numbers in for your company into that equation, you'll get a predicted probability of change. So, some of the things that have tended to work in these probits: stock price, performance, structure of the board. Is it a small board or a big board? Is it independent or dependent? Ownership structure. Companies with a lot of insider ownership, it's more difficult to create change when you have dispersed ownership. And industry structure. In some industries, it's easier to change the management than others. But if you do all of that, you're saying, why bother? Why come up with an expected value control? Because it surrounds us. I'm going to give you four scenarios where the expected value control comes into play. When you look at a publicly traded stock and you see the stock price, what is the market building into the stock price? First, it reflects the status quo, what they think about the company. But does the market think about the likelihood of change? Yeah. And what will happen is implicitly, when you look at the price, embedded in that price is the status quo value plus an expected value of control. That's why the minute an activist investor shows up in a company, you're going to see the stock price jump. It's not because the value has changed, the company has become more valuable, but now the likelihood of change has increased. In the period that Nelson Peltz and Bob Iger had their fight, does anybody know what happened to Disney's stock price?
I know Nelson said he made 300 million off this.
And in fact, the price was down to 78 or 76 at its low. And if you look at where it's now and you look at the jump, almost all of it, you can argue, is coming from people reassessing the likelihood of change. But you're saying Nelson Peltz lost. For the moment, Iger is won, right? The reason I say for the moment is for the next year, Disney still has trouble. I'll wager there'll be somebody else, maybe a Bill Ackman who will show up. Maybe a Carl Icahn. I mean, it doesn't have to be the same activist. It's essentially somebody pushing for change. So I'm going to start with that and talk about how, when you look at a price, embedded in that price are the expectations that change will come. I'm going to also talk about, in a hostile acquisition, the value of control, that mythical 20%. We'll talk about how to quantify how much to pay for control in a merger. Not synergy, but just control. I'm also going to argue as a bonus, if you can come up with an expected value of control, you have a way of telling me how much of a premium voting shares should trade at over non-voting shares. Let me step back. Everybody agree that if I have 2 classes of shares in my company, that the voting shares should trade at a premium over the non-voting shares? Okay. Anybody value Meta in this class? Somebody must have, because I saw at least 3 Metas on that list. Okay. How about Google? Did anybody value Alphabet? Guys are all going into hiding now. Did anybody value any company with 2 classes of shares? Yeah.
Well, I switched at the end of Paramount.
Yeah. So if you have 2 classes of shares, here's the problem you're going to do. You come to the value of equity. How do we get value per share? We divide by the total number of shares. If we have 2 classes of shares, we often just add the 2 classes together, come up with the total number, and come up with the value per share across the classes. But that's a little unfair, right? Because a voting share should trade at a premium over non-voting shares. Bankers often attach an arbitrary premium to it. But I'm going to give you a way of actually estimating what that premium should be based on the expected value of control. And finally, let me go back to private company valuation. If I offered you 49% of the NICs, you should pay a lot less than if I offered you 51% of the NICs. Why? 49%, who continues to run the NICs? The most hopeless ownership team in history, right? These guys don't even deserve to go to the playoffs. It's almost like accidental that they're there. This should be one of the most valuable franchises in the country. So with 49%, James Dolan runs a company. With 51%, you can toss James Dolan out and say, you can't come into the arena. Okay? And you run. Do you see the difference? With 51%, it's your company. You can run it for the optimal. You can make the changes. That's called the minority discount in private company valuation. That 2%, 51 versus 49, can make a huge difference in how much you're willing to pay. So let's take each of these. Now, publicly traded firm, markets know that there's a status quo value. Markets also know that there could be a different value if somebody else ran the firm. With Disney, both those numbers are out there, but where the price will be between those two numbers will reflect the likelihood that investors attach to change coming at the company. That's why Nelson Peltz made a difference in the price. The likelihood of change went up the minute he showed up. So when you buy a company, if you valued a company and you did and most of you did status quo values, so the price is higher. One reason the price might be higher, and Paramount is a classic example, is that's a company that's a basket case when it comes to the status quo. As long as Sherry Redstone is in the company, no path to health is going to be basically available, and she owns the voting shares. So there you can argue there are two values, and what you see as a price will reflect the likelihood of change. Take a hostile acquisition. You heard of, none of you, have any of you been in a Blockbuster? You've been in a Blockbuster? You were the original one in Washington State? There's one left, I think. It's like a monument to it. There was a time when there was a Blockbuster every few blocks. It's one of the great success stories of the 1990s because it was built up through roll-ups. They went and bought, video rental stores after video in different cities and built up huge growth company. Every year they were open 15 new stores, and you went in and even if nothing, you'd make a virtual visit, I'm sure somewhere online, and you'd go in and there'd be all these tapes initially, and then they became DVDs, and you'd pick a tape and you'd rent it. You got it for 3 days. And then what Blockbuster hoped was that you forgot to return it within 3 days, because every additional day they'd ask you for an extra child or your house or something in addition. It's a business model that made them a lot of money. And then two things happened in the late 90s that started put the business model under risk. What was the first? Sorry? Netflix was born. People don't realize how old Netflix is as a company. I actually was a Netflix member when they first came into existence, and they would mail you. So you'd pick a DVD and they'd mail you the DVD. And then when you watch it, you'd mail it back. See how 19th century. No, that was very 20th century. And Netflix basically became a competitor. At the other end, you had, Walmart setting up those red boxes outside where you could rent videos. It was like a vending machine. But they did only the 30 most watched videos. But let's face it, those accounted for a third of Blockbuster sales. So Blockbuster got squeezed and fewer people were coming into the stores. But here's the problem. Blockbuster continued to be run by management that was in denial. So every year they'd open another 50 stores until finally people noticed, why do you keep opening stores? Nobody's coming in. So in 2005, Blockbuster was down to $6 per share. Okay. And then an activist investor popped up and the price jumped the minute the activist investor. I actually valued Blockbuster twice in 2005. The status quo value that I got was $5. It was run as an insane company. You keep opening 50 stores every year, nobody's coming into it, you can destroy value. I revalued at $12.50, assuming they never opened another store again, and they kept closing 10 stores every year. They got $12.50. $5 and $12.50. The price is already up to $9.5. Let's suppose you believe the $12.50 as the intrinsic value if you run them. That's the value control in this acquisition, right? Would you pay that $2.97 as a premium over the market price? Andrew?
Not because only gives the company what it is.
If you do pay the $12.47 for the target firm, what will you earn on that investment?
Nothing.
No, that's not true. If you pay for, you will earn the cost of equity, the cost of capital. If you pay fair value, it's not that you earn nothing, you earn the cost of equity capital. You're saying, what's wrong with that? You're doing the dirty work of earning what you could have done in an index fund, right? So here's the first thing. If you know what that value of control is, you're trying to negotiate to keep some of that for yourself. Otherwise, why bother? So in the value of control, to do it, you actually have to value the company twice. Let's talk about voting and non-voting shares. In Brazil, for much of the last century, every company in Brazil had voting shares and non-voting shares. The voting shares were called common shares, and non-voting shares were called preferred shares. Preferred shares in Brazil are not like preferred stock in the US. They're actually non-voting common stock. And there's a company called Embraer. Embraer makes, if you've ever been in a small aircraft in the US, taking one of those short flights, it's either a Bombardier or Embraer. So this is the 30, 40 people aircraft. So it's a well-regarded airline. I valued it twice. $12.5 billion as the status quo value and $14.7 billion assuming that it could be run differently. Embraer faces a whole lot of constraints on it. The government interferes constantly. I said, if you can run the company as a true aircraft company, what would it be worth? So I have two numbers, 12.5 and 14.7. They have two classes of shares, 242.5 million common shares, voting shares, and 476.7 million non-voting shares. So here's what I'm going to do. I'm going to try to value each class of shares. So you guys own the non-voting shares, you guys own the voting shares. If you get a non-voting share, what exactly do you get? You get a piece of the company, but absolutely no power to change the way it's run, right? So what does that mean? You're stuck with the status quo value. You don't like it? Tough. So here's how I'm going to get the value per non-voting share. I'm going to take the status quo value of 12.5 billion divided by the total number of shares outstanding, and I'm going to make that the value per non-voting share. So that's become the non-voting share. As a voting shareholder, what do you get the power to do? Change the management. It's not a whole lot of likelihood that can happen, only a 20% likelihood, because one of the big institutions that owns the voting shares has to be on your side, but it's not impossible. Let's say there's a 20% chance of that happening. Remember that I have two values, 14 points. So $2.2 billion value of control, 20% of 2.2 billion is 440 million. I divide that expected value of control by just the voting shares. Only you get that control. The value that I get per share is $19.19. So my voting shares trade at a roughly 10% premium over the non-voting shares. But why? Because the company is not perfectly managed and because I have a chance of changing management. Google has three classes of shares. Class A shares have 10 voting rights. Sergey Brin and Larry Page own a big chunk of that. Class B shares have one voting right. So basically have one. You know what Class C shares have? No voting rights. It's almost like Google got tired of insulting you and insulted you even more by saying, hey, you like 1 per 10, how about none? You have three classes of shares. So given what we did with Embraer, if I ask you, should there be a difference in pricing the A, the B, and the C shares? What's your answer going to be? What are the two things it's driven by? Is Alphabet perfectly run? And right now we all agree it's not perfectly run. But what's the other thing? What's the chance I can change the management of the company? And what's the answer to that? Zero. Historically, Google's Class A, Class B, and Class C shares have roughly traded at the same price. It's not because the company is perfectly run, but because you kind of given up on the value control. So the next company you see with two classes of shares, look at that spread, because it's going to tell you both about what people think about that company, how well or badly it's run, and the likelihood of change. Talk about minority discounts. A few years ago, I valued a candy company twice. Status quo value is 1.6 million. The optimal value is 2 million. So I offer you 51% of this company. What's the most you're willing to pay? 51%. With 51%, what do you get? You get the complete power over the company. If you want to run it optimally, it's your power. You're willing to pay up to 1.02 million, 51% of the optimal value. If I offer you 49% of the same company, you have no chance of changing the way. You're going to take 49% of the status quo value. That 2% difference in ownership stake translates into almost a 25% difference in value. That's the minority discount. Minority discounts are going to be greater in badly run private companies than in well-run private companies. The expected value control is a neat little device for thinking about why do things happen the way they do out there. So that's value enhancement, as you can see, just an extension of basic discounted cash flow valuation. But to do value enhancement right, you need to understand corporate finance, which you should, right? You've taken the class, but that's kind of the first step. So if you feel that your corporate finance basics are shaky, go back, because you really need to understand how much can I borrow, how should I take projects to be able to do value enhancement right. Which brings me to shortcuts. We're a consulting firm. Remember, the cream of consulting is what's called value consulting, where you tell the CEO how to run the company and how to make it more valuable. And if you're a consulting firm, they're almost always looking for a shortcut, because discounted cash flow valuation, think of all the levers, right? Growth and margins and reinvestment and risk. And they pick a variable that they think is a shortcut to value. It can be growth, it can be margins. Basically, they're picking one of the variables. Just focus on that. And can it work for a brief period? That shortcut can work. Okay. So the advantages of these shortcuts is they're simple. You don't have to think about DCF model. You just have to focus on increasing your margin or increasing your growth rate. The disadvantage is when you use a shortcut and you're ignoring all of the other stuff, it's easy to make stupid decisions, focus on just increasing growth or increasing margins. So every consulting firm through time, this has become the game. It's to first come up with an acronym you haven't heard of, then convince you that this acronym is better than the old-fashioned discounted cash flow model, and then finally make yourself an essential ingredient to be able to calculate the acronym. So I'll make this specific. In the early 90s, there was a consulting firm that was founded in New York called Stern Stewart, founded by Joel Stern and Bennett Stewart. And I knew them well before they founded the firm. Neither person is deep enough to do consulting, but they know. Joel Stern was a one-trick pony. His only thing was don't pay dividends, don't pay dividends. And he'd been saying that for 20 years. And Bennett Stewart knew nothing about finance, but he was a good salesperson. He could sell refrigerators to Eskimos. They start this firm and they concoct this acronym called EVA. For the longest time, whenever I put EVA, I had to put the little circle with the R in the middle because they trademarked EVA. This was the amazing, insight you got from EVA. It basically compares the return on capital to the cost of capital. It tells companies you should try to earn more than your cost of capital. Amazing, amazing. I'd never thought about that until Stern Stewart come along. And they said, if you do this on bigger projects rather than smaller projects, it's even better. Earning a 3% spread on $3 billion is better than earning. And CEOs lapped it up. This is such insight, which tells you a lot about what CEO caliber is, that you think this is an amazing insight. But you know why CEOs like it, right? They had an EVA number on their desk, and compensation was tied to increasing EVA. So I want you to do something incredibly perverse. This is don't worry. It's a perverse in a financial sense of way. I want you to think about being the CEO of a company, and I want you to think about ways you can increase EVA while destroying the company you're in charge of. What are some of the things you could do to make your EVA look better, but are bad for the company? Yes. Well, invest less in what? First is, if I give you two projects, one of which is you actually want to you want to invest in big projects rather than small projects, because remember, EVA is a dollar value. But you also want to look for loopholes, because how is invested capital measured? Based on what's on the balance sheet. In the 1990s, leases were not treated as part of debt. So if you leased an asset, instead of borrowing it, it didn't show up as part of invested capital. Magically, you had higher EVA. You could also pick short-term projects that increase your earnings now at the expense of longer-term projects that increase value. Value is always long-term, right? It's a present value of cash flows. But because you're focusing on a single year's EVA, I can do strange things. And companies played all kinds of games. Stern Stewart eventually went out of business, and thank God for that. But this was not magical insight. And there was a point in time where half of all the S&P 500 companies were using EVA. A variant, Holt Associates, a Chicago-based consulting firm, created this acronym called CFROI. What's CFROI? You know how when you do capital budgeting, you compare NPV to IRR? Think of the EVA as the analogous to NPV. CFROI tries to compute an internal rate of return based on cash flows for companies. And there again, the objective is earn an internal rate of return that exceeds your cost of capital. But you can see the appeal to CEOs, right? Instead of looking at all of these different levers, all they have to do is focus on one number. But they're both subject to gameplay. So here's the bottom line. There is really no new way to value companies. Cash flows, growth, and risk, and all of these approaches just take a narrow version of that valuation and assume things away. So when you see people saying this is a better way to do valuation than discounted cash flow valuation, not true. You talked about APV. The big thing with APV is, no, you know what? You don't have to bring your debt ratio to cost. You're right. But are you bringing in expected bankruptcy costs? So when people suggest shortcuts because it looks simpler, look behind the shortcut. There's always an implicit assumption that's going to blow up on you. So let's turn to your pricing. Remember that 4-step process for doing pricing better? Define. Consistently defined, uniformly estimated. If you have an equity value in the numerator, equity value in the denominator, enterprise value in the numerator, so start. Uniformly estimated. Make sure you're estimating the same way for you saw already when you tried to do this for your company how tricky this was, right? Because if you capitalize leases for your company and other companies did not, it created a mismatch. So is it consistently estimated? Is it consistently defined, uniformly estimated? Second stop, remember it's all data, right? Play Moneyball, look at the distribution. Don't fall for rules of thumb. What's high, what's low, let the data tell you. Third stop, remember embedded behind every multiple are all of the assumptions about cash flows, growth, and risk you're running away from. Remember that technique of if I gave you an equity multiple, you go back to a dividend discount model? Not because you want to use it, but because it tells you the variables you should be controlling for. And when you get to applying it, remember there is no peer group which looks just like your company. You have to control for differences. Whether you do it with a regression or something else, I don't care. But you cannot just compare your PE ratio to the median and expect to get something that has any heft to it. And if you remember, now with each multiple, we went through a discounted cash flow model. So this is just a summary of with the equity multiples. You go back to a dividend discount model, you do the algebra. And with every multiple, you get the variables that drive that multiple. And you also get what I called a companion variable. Remember the companion variables, the one number you need to know to use that multiple. The price to book, it's return equity. Price earnings, it's growth. With enterprise value to sales, it's operating margin. It's not magical. It comes right out of the discounted cash flow model. So here's what you used. God, it's only a matter of time before everybody uses EV to sales. Some of the EV to sales was desperation, right? Why? You started climbing the income statements and negative, 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 negative. Oh, finally a positive number. Okay? Thank God revenues can't turn negative. It's only a matter of time before accounting figures out a way to make your revenues negative. Luckily, none of you are doing pre-revenue companies because then even revenues are zero. There you got to keep searching, right? Number of users, number of subscribers. So the denominator has to be a positive number, a lot of EV to sales. That breakdown has changed over the last 20 years. 20 years ago, a lot more PE and price to book. Book value has kind of receded over the last 20 years, partly because accounting book values become less and less meaningful. Some of you had negative book equity for your companies. Not uncommon. 10% of all US companies have negative book value. It's not just small companies. Home Depot has negative book equity. Apple next year will have negative book equity after the $110 billion buyback. It's no measure of whether the company is healthy or not. It's just a reflection of the fact that accountants haven't caught up. And here was what you found relative to, so I took each of your DCF values to the pricing to see whether you got a higher number with your DCF value of the pricing. And the reason I do that is I often hear people saying discounted cash flow valuations give you a conservative estimate. Implicit there is DCF value will always be lower than the pricing. Okay. Well, it's true. For your companies, you had more companies where the pricing was higher than your DCF value, but that's not a huge difference, 109 versus 1. On average, your median company, your DCF value is about 4.5% less than your pricing. If you look across time on these classes, that number has gone from positive. So it's kind of a reflection of the time we're in that your pricing is giving you a slightly higher number than your DCF. And here were your most underpriced stocks. I should take that out actually. No, it's the WeWork. So the pricing, what's your peer group that you ended up at the 98, 99?
State operation.
Okay.
Companies based in Houston.
And this is where the optionality in WeWork might come in. They own valuable enough properties that if you could restructure the, what, the basic, tell the class what the basic problem with the WeWork business model is.
So it wasn't duration mismatch.
Yeah.
They were basically subletting out their office space that allowed companies to take.
Come in and out. So when times are good, you fill every space. When times are bad, everybody leaves. You still are caught up with a 40-year lease. That's always been the WeWork problem, but they have some properties that are in the best. I mean, you go across the world and you look at the WeWork building, it's actually often in the best part of the city. It's a high rent neighborhood. So there is this escape hatch, and that's what the pricing is saying. Look, these properties are worth a lot if you can fix the business model. Right? And you can see the rest of the companies are, all on the list. There, almost all of them are, there are a couple of UK companies. Air Arabia, it's comes out as a massively undervalued, underpriced company. But these were your most underpriced companies. Here are your most overpriced companies. I mean, the person who valued Beyond Meat was very negative about the company. So I don't like Beyond Meat myself, so I kind of sympathize. But Beyond Meat, of course, when it came out as an IPO, this huge upside. My problem with Beyond Meat is who does what's a niche market that Beyond Meat is targeted at? It's not vegetarians. I grew up in a country where I had more vegetarians around me, and a vegetarian wouldn't be caught dead eating something that tastes like meat, right? They'd throw up. This is for people who love meat but feel guilty eating meat. So it's partly guilt, and it's got nothing to, it's not health, because if you look at a Beyond Meat burger, it's not that much healthier than a regular burger in terms of, the stuff. But you're saying, look, I'm not destroying the planet while I'm eating. So that's a pretty small niche market. People who love the taste of meat but feel guilty every time they take a bite of a burger. So I'll give you something that tastes exactly like a burger. I've never liked the taste of meat, so I don't like the taste of Beyond Meat either. But it's clearly the glory days have kind of run out. So once they hit the fast food places and they got that initial growth, it seems to have leveled off. So it comes out as the most over. But you can go down the list. Some of those names I don't know, but Tesla is there as one of the overpriced. I hope you're wrong, because I bought Tesla a few weeks ago, but no, we'll find out. Yeah. So Peloton is a company that was $50 per share just a couple of years ago. It's now to 342, and there seems to be no floor on this stock. So those are your most overpriced stocks. Now, I did ask you to do an option pricing model on your company if it met two conditions. What are the two conditions, Warren? Money losing, a lot of debt, right? It's a liquidation option. About 8 of your companies met that. I think it's more than that. I should have counted better. But in each of those companies, I looked at your option value versus the DCF value, and there was a premium of about 30-40%. And that's why the option pricing model is so attractive, is you can have a company where your DCF value basically gives you that equity is worth nothing, like an AMC, but you could have optionality. Same thing with the WeWork, right? It's a company that's underwater, but if they ever figure out a way to get that business model fixed, there's optionality. When you have a lot of debt, all you need is a little rise in the value above that debt, and your equity starts to become incredibly lucrative. So you got to this point, and I asked you to make a decision. And God, you are like Hamlet, right? Is I feel like buying, and I got at least 50 emails asking me basically to hold your hand while you're at BUY or SCLL, or can I hold? And the reality is, this is about you and you, right? It's whether you're comfortable. And I know at this point you're saying, I don't feel sure yet. You know what? You'll never feel sure, right? That's never going to happen. Some of you at this point said, look, this is all an exercise in number crunching. I'm just going to buy an index fund and move on. Very healthy recognition of where you are in this process. But to me, the reason it's so, you felt so uncomfortable pulling the trigger on a buy or sell is you thought about putting all of your money into this company. And of course you should be terrified, right? Because even if you've done all your, but let's assume you have 10 other companies in your portfolio. You think you'll feel a little more comfortable pulling the trigger on the 11th company? Yeah, you got some buffer, right? I've never believed in concentrated portfolios precisely for that reason. When you have really concentrated portfolios, it becomes really difficult to say buy because every mistake could screw up your entire portfolio and damage your lifestyle choices. I mean, I have a rule when I add a stock to my portfolio that it never exceeds 5% of my overall portfolio. I don't care how upbeat I feel about how amazing it is, how much of a slam dunk I think the value is, never more than 5%. I bought Tesla 3 weeks ago. Did I feel comfortable? How can you feel ever comfortable buying a stock like Tesla? Right? You're one stop away from a freak out. But I'm okay with it as my 43rd stock in my portfolio. If it were 3 stocks in my portfolio, there is zero chance. So if you feel uncomfortable pulling the trigger, part of the reason for that is until you get enough of a buffer, buying that first stock, you think, so how do I get to the first stock? Buy an index fund for a while. Which does mean that you don't invest to get rich, you invest to preserve and grow your wealth. You'll find yourself more willing to make that decision. So here were your buy and sell recommendations. You had 89 buys and 119 sells. Your buy to sell ratio is 0.75. So you're definitely not sell side equity research analyst, right? Because what's a buy to sell ratio for a typical sell side equity research analyst? It's about not quite 100%, 8 buys for every sell, right? You're 0.7. Because you're investing. See, notice how much more conservative you get when you have to think about investing your own money. Okay? So I don't know. It's your money you're buying with, And that 0.75 reflects what you think. This morning in the MBA class, I computed that statistic. The MBA class at 0.59, they're even more pessimistic, but they're older. You get more pessimistic as you get older. You might be at peak optimism now. From here on, it's all downhill, right? If I took a bunch of 80-year-olds in the class, they'd be at 0 buys, all sells right now, Time horizon is very short, and I don't know whether I'll get there anyway. So, and just to give you a sense of where you stand in the larger scheme of things, I've kept track of the buy to sell ratio. So you remember what yours is, right? 0.75. This is, see the yellow line? That's my buy to sell ratio over time. So spring of 2020, actually, that was the COVID spring. It was actually around 95% buys for every, and it dropped off in 2021 to about what it is now. But to show you that this isn't a leading indicator of the market, 2021 through 2023 has been a pretty good year for stocks. So I'll track it, but I don't trust your market timing instincts yet to do much with it. But it's a number I track through time because it gives you a sense of collectively what is the angst that you feel about the market. And right now, people are a little uncomfortable with where we are, and it's showing up in that statistic. So you've done an intrinsic valuation, done a pricing, and I didn't ask you to, so as you did the pricing, some of you had issues with the pricing. You said my R squared is terrible. And I say, you can't get blood out of a stone, just use the median. I said, I won't trust the pricing. Then I said, fine. I didn't ask you to trust the pricing. Ultimately, you make a decision. What you base it on will depend on which of these numbers you feel more trust in. You might not trust either of them, but which one do you trust more in? So ultimately, when you think about what approach, intrinsic value of pricing, it'll depend on first what you're valuing or pricing. If you're valuing a stock, you're clearly going to have it both choices. If you're trying to put a number on Bitcoin, you can only price it. Currencies can't be valued. It'll also depend on you. Okay? And that's why I didn't impose one over the other. If your time horizon is short, and if I asked each of you what your time horizon is, you know what you're trained to say, right? What's the answer that makes you look wise and deep? I have a long time horizon, really long. I'm like Warren Buffett on steroids. And the truth is, it's really not in your control. You were born with a degree of impatience that you can't change. Some of you can't hold a stock for 5 years. So it depends on you. It depends on your time horizon. It depends on why you're putting a number. If you work for a bank, your job is pricing. So don't do a DCF when you're asked to do a pricing. And what you believe about markets. Remember, if you think markets correct themselves, make mistakes and correct themselves over time, intrinsic valuation works better. But if you believe they're right on average, but wrong across stocks, then you're going to do pricing. So this was a question I asked you, I think, in session 2 of this class. At that time, you said, I've never done a DCF. I don't know what that means. You've done one DCF at least, maybe 2 or 3 if you've done the valuations of the week. But I want you to think of this as a work in process. As you think about, as you get immersed, you might decide that you prefer the logic of intrinsic valuation because it forces you to think about the business. Or you might say, look, pricing is much more honest. It's what people pay. I'm not going to build these elaborate castles on growth and cash flows. Or after this experience, you might have a little more respect for markets. Because people talk about market inefficiency as if it's this casual thing. And when you recognize what markets do every moment of every day, you have to be in awe. I mean, think about it. You come up with one number for NVIDIA, millions of people with very different views gathering. To me, that's magic. So even when I disagree with markets, I have to step back and respect that they have come up with a number. And it's a number that's an actual monetizable number. It's not some number that we have in a spreadsheet. So, no, if you decided by now that you don't want to do intrinsic valuation or pick stocks, you might have saved yourself a lot of money over the rest of your lifetime. You say, what do I do with the rest of my life? Go back to living it. You know, get a job, accumulate an income. This becomes a way in which you preserve and grow your wealth. And that's perfectly okay. In fact, it's a healthier choice for most people. You know? So remember that question I asked you at the start of the class? You're a storyteller. How many of you were storytellers when you came in? Huh? Come on, Faiz, you can put your hand up. Okay. So if you're a storyteller, I hope you're a little more comfortable with numbers. It'll always be more natural for you to tell stories. But now when people talk about margins, you can ask the question, operating or net. Even if you have no idea what you're asking, ask that question, operating or net. If nothing else, it'll throw them off their game and it'll tell you whether they know what they're talking about. Or when they talk about ROIC, consultants, or do you know what the ROIC of the company is? Fully expecting you have no idea what's a ROIC. You know what a ROIC is. You say, did you capitalize R&D? Completely throw them off again, right? You know the questions to ask when number crunchers try to intimidate you now. You have the weapons to do it. So if you're a storyteller, I hope you're comfortable enough with numbers that you're not going to get intimidated by a banker putting up a 10-year spreadsheet and trying to bulldoze you. If you're a storyteller, I pray you're willing to give your imagination a chance. I hope you're okay not being able to check whether you got the right answer. I mean, it's tough, right? Because you've been trained, you know, how do I know I'm right? And the answer is you don't, and you have to be okay with it. It's as much a psychological barrier you got to get over as it is a financial barrier. I don't give life advice. I make enough screw ups in my life. I don't want to be going out spreading those screw ups, you know. But I'll give you at least some valuation advice along the way. I'll sprinkle perhaps a little bit of. First, I mean, in my 40 years in markets, fundamentals come in and out. I'm told, in the 1990s, I was told, no, it doesn't matter anymore that you build a business model. And we discover over and over again that when people say that, the truth is we eventually always return to fundamentals, cash flows, growth, and risk. Whether you do a DCF or not, that's something you come back to. Second, there's so many details you can get stuck on in evaluation. Remember trying to compute the equity risk premium? There were some of you spent 2 days trying to figure out what risk premium should I attach to the rest of the world. At 11%. You know how much of a difference it actually made in your valuation? You could have just used the global equity risk premium to got roughly the same number as the 2 days you spent researching how many Starbucks there were in the Caribbean. You probably flew out to the Caribbean just to count them. And I found 7 Starbucks. This will make my valuation much better. And it's not your fault because when you often first start doing valuation, you don't know what things you should spend time on and what things you should just brush over. So why don't you just tell us not to, because the lesson sticks when you try something and you recognize 2 days later, it didn't make a difference, right? Third, you're going to go out there and you're going to see some 50-year-old trader say, I've been doing this for 27 years. I know what I'm doing. This is a business where there is no learning over time. You can spend 27 years being stupid, rise up the ranks, and you'll have all these anecdotes. I did this in 1999 and it worked. Give them the statistics of what happens when you have a sample size of 1, and you kind of magnify from that. Keep your perspective. It's only a valuation. I've never once laid awake at night saying, maybe I got the margin wrong. If you are, let it go. I remember about 12 years ago, second year MBA, I was going through my evaluation class. She's a history major from Yale who came back for an MBA. And usually if you're a history major from Yale coming back for an MBA, you basically pick every class with the word strategic in its name. Strategic marketing, strategic accounting. This is accounting without ever seeing a number. Balance sheets that balance in virtual space or something like that. And she ended up in my class thinking it was a strategic valuation class, and it wasn't. But she turned out to be pretty good at it. She was one of those storytellers who very quickly caught the numbers. So she comes to me at the end of the class. She said, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences. No, I said, my congratulations. And she said, I'm really scared. And I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. Brain surgeon makes a mistake. Somebody dies on the table. You make a mistake. What's the worst that happens? Somebody gets a little richer. Somebody else gets a little poorer. Just make sure that somebody who's getting a little poorer is not you. That's the only requirement. Think like a Marxist. You move some wealth around. The world hasn't ended. Move on. And finally, if you're ever given a choice between knowing everything there is to know about valuation and being lucky, which one should you pick? Pick lucky every single time. I would love to tell you that this is a business dominated by skill. That's what hedge fund managers like you to think. I'm successful because I'm really good. You got successful because you were in the right place at the right time. I mean, brought home to me by my mother-in-law when she came to visit in early 2000, peak of the dot-com boom. She comes to visit all day long. All she would talk about what was in her portfolio, what was out of her portfolio, what she wished was in. And I had to act like I was listening. That's what son-in-laws do. And then she lets it slip that she owned Qualcomm, one of the great stocks of 1999, up 400%. And I was impressed. I said, Judy, how do you pick Qualcomm? I don't know why I asked these questions because she told me. She said she picked Qualcomm because it owned MCI. I said, that's not Qualcomm, that's WorldCom. She says, Qualcomm, WorldCom, what's the difference? I said, you bought the wrong company. If you'd actually bought WorldCom, the stock that owns, the company that owns MCI, you'd have lost money. Instead, you bought Qualcomm and made 500%. She wasn't in the least bit phased. I was afraid to ask her after that why she owns Cisco. Afraid the answer might be, I really like their vegetable oil. Saturday Night Live, Crisco, Disco, who knows what drove it, right? But after she left, I tried a strategy. I'd pick a stock in the news, pick one that rhymes with it. If I'd made a lot of money, this entire class would have been about rhyming stocks. Every session I'd come with these two stocks, look, their names rhyme. When one gets in the news, buy the other one. Not the one that's in the news. Didn't work for me, so I kind of let it go. And I'm going to leave you with a final bit of advice, and this is subversive. I used to teach every investment banking analyst training program. And at JP Morgan, I did for 36 years. I did Bank of America, Goldman Sachs, and so basically investment banks would ask me to come in and teach corporate finance their way. And of course, I would come in and teach it my way. Okay? Which is basically, the banker's going to ask you to use a Bloomberg beta. Ask them what the adjusted beta is. I basically created a lot of friction, I'm sure. And then as my final piece of advice, I would tell them to preserve their option to abandon. And I'm going to give you that same advice. You know the option to abandon is? I'm assuming a lot of your seniors, I was looking at the list, most of your seniors, and in a month, 2 months, 3 months, you're going to start work. Preserve. Why do you keep banging your chest? I'm afraid you're going to have a heart attack if you bang it long. So you're going to get out there, you're going to start work. Preserve your option to abandon. What does that mean? Well, that Saturday night, the managing director comes in and throws an annual report, that jerk who basically keeps you around for 80 hours every week because he has a dinner plan. So you sit at your desk waiting for him to come back or her to come back, throws the annual report, says, I want this valued on my desk tomorrow morning. You know what the option to abandon will look like? You take the annual report, you throw it back in his face, you do it yourself. Tremendously satisfying moment, but to be able to do that, you got to live like a student for another year, right? The minute you get out, you get that $5,000 apartment in West Village and you put down a down payment on a car you can never drive, but you pay, your option to abandon is gone. You think about it for a moment, say, no, I can't do that. I have a rent payment coming due. Preserve your option to abandon. It'll make you a much better employee. The problem in banking is you get golden handcuffs. And once you get golden handcuffs, who wants to rock the boat, right? So when somebody says, let's lend to people who have terrible credit histories and act like they have AAA ratings, you say, what? That's stupid. And then you say, oh no, great idea, let's do it. Okay? This is how disasters happen in banking, is because you know that what you're doing doesn't make sense, but you do it because you're afraid that if you push back, you're going to have to exercise your option to abandon. But that's what will make you a more useful, because you will speak up. So preserve your option to abandon. I've been giving out this advice since the late 80s. Every year, there are at least 5 people I get emails from. Today, I exercise my option to abandon. Please send money. I ignore the please send money because I hoped you built something up before you did it. But preserve your option to abandon. I told that to my 4 kids. One of them hasn't taken the advice. He's paying $8,000 with 3 other people for an apartment. His option to abandon is dead. So when he complains about 100-hour weeks, I said, your option's gone, right? So you probably heard Bank of America's analysts and associates are suing the bank. Many of you are going to be asked. And the worst thing is not just that they make you work a lot, but it's on useless stuff. It's on point. I mean, I've described investment banks as taking some of the brightest minds out there and essentially wasting all of that intellectual power because they don't let you use your intellect. So don't give up, don't quit your job or something before you even start. But keep that power of saying, I will walk away, because nothing is worth hanging in there just for that next paycheck. You're saying, but I'm young, I can, once I get wealthy, then I'll go off to the Caribbean. You're taking the best years of your life and essentially losing them if you don't really, at least partially. You're never going to enjoy every moment of what you do. But try to at least hold on to something in there of value. Right? So that's it. And I will see you at the early final. I will be at the other class. So Jake will be monitoring the early final, but I will be here next Monday for the regular final. Okay? I'll see you.
We submit. No.